Hey guys, I'm back with another video, and today I'm going to be talking about Honest. I'm going to be talking about what this company is, why it's undervalued, and why I'm investing in their stock. So first, Honest is a consumer goods company that provides safe and effective products for baby, personal care, cleaning, and vitamins. And they just make basically sustainable items that take a lot of the chemicals and things that are considered unsafe. So that's their target audience, is people looking for safer products. Now, this is from yesterday. So the Honest Company, the stock sank 19% in extended trading hours yesterday on Thursday after they reported a 10 cents loss per share. And analysts were looking for a loss of 6 cents per share. So, it's a pretty significant miss on their part. And then if we go to today, today the stock was down 22.5%. And, at close, the stock price was $4.68. Here's their market cap, $426 million. And their 1-year target estimate on the stock is $12.50. Now, if we go over here, this is from Google. This company in 2016 had $250 million in sales, and it was valued just shy of $1 billion as of October 2017. So, a little more than 4 years ago, almost like 4.5 years ago now. So, here I have the sales that they were doing in 2016. And this is the sales that they just reported for this year, which you can see right here, 2021 sales. So, in between 2016 and 2021, their sales have increased by 27%. And the company was valued at $1 billion, but now the company is only worth $426 million. So it's basically worth like half the amount, even though their sales have increased. And back then they weren't public, they just went public last year. Now if we go here to their quarterly earnings, so here we have their balance sheet. So right now they have $50 million in cash and cash equivalents, and in total assets they have $272 million. So this increased, from 30 million last year to 50 million, and then their total assets increased from 240 million to 270 million. And then here we have their liabilities, and their liabilities actually decreased from 101 billion to 93 million. And if we go over here, the average estimate loss per share for this year of 2022 is 12 cents a share. So right now they have 91 million shares outstanding. So if they were to hit this number, then they would lose 10 million, almost $11 million this year. And next year would be projected to be minus almost $1 million. And their sales growth would be increasing about 15% this year and next year. So if they lose $11 million this year and $1 million in 2023, then right now they have $50 million in cash, and assuming that this doesn't change, then they would still have around 39 million, around that amount. So they definitely have plenty of cash on hand, and they're not going to be struggling anytime soon. And here, in 2023, they're barely going to be losing any money, and they might actually beat this number, which hopefully they do. But definitely in 2024, this company should be profitable. Now, how profitable, I don't know. I would assume that it would be, at least 10 cents a share in profitability. So, that would put us around $10 million in profits for the year of 2024. But, hopefully they can do better than that and they can grow much faster. Now here, I'm going to show you why this stock is undervalued. So using this calculator, it's a Graham's number, you can look it up online. But basically, if we take the current stock price of $4.68 and we take the current book value, which I got off of Yahoo Finance, and if we assume an earnings per share of 10 cents a year for 2024, and we're going to cap the maximum PE and the maximum PB at 30 and 10. So I think this would be pretty in line for a growth stock. I would consider this company to be in its growth phases right now. So this calculator is to find the maximum price that we should pay for a stock. So we don't, by putting this 30 PE ratio and this 30 and I mean this 10 PB ratio, we're basically saying that we wouldn't want a company that has more than that. So like let's say if this company has like a 100 PE ratio, then it would just be like massively overvalued. So we're going to try to keep it in line with other growth stocks, across different sectors and across the market. So here, after doing this calculation, basically the fair stock price right now, assuming that they earn 10 cents a share in 2024, the fair stock price would be $7.71. So that gives us a margin of safety of 64.7%. And basically that means if we buy this stock at this price, and this is a fair valuation, then if the stock went from 468 to 771, we would gain almost 65% off that move. And then here is the current discount that we're getting from fair value. So fair value 771, current price 468, we're getting a discount of 39.3% or $3. But if the stock goes up, then we would earn almost 65%. So based off of this and their balance sheet and their sales growth and their projected earnings in future years and projected profitability, I definitely think that this stock is a buy, and it'll definitely be a buy. I would say up to this number, you're getting a great deal. Up to $7.71, you're getting a great deal on this stock. You're getting a value out of it. You can definitely buy this stock. You can buy more. Maybe like you can buy up to $10 or something. Like I don't have really a number for that, but for me, anything under this and up to this number is a buy for me. So yeah, I'm definitely going to be piling in some of my money this year into it. Hopefully this company stays under this price for a while. I definitely think it'll stay under this price for at least this quarter and the second quarter. So for the first half of this earnings year, it'll be under this, and maybe after that it'll start moving up. So you definitely have plenty of time. You have like at least 6 months to be accumulating shares, unless something drastic happens and it just suddenly goes up. But those are my thoughts on this company and this stock. So just let me know what you think, and let me know if you want me to talk about anything else. I'll see you guys next time.